Welcome to the Fund Your Retirement podcast.
We've just kind of come across the top of what DeFi is. Decentralized finance, like we had talked about at the very beginning, is kind of a blanket term. So we've talked about what are stable coins. We've talked about decentralized exchanges, but there's even more happening in the space, like lending and borrowing protocols, what they call smart loans that auto repay themselves based upon the interest you're earning. There's insurance for all of it. There's margin, different things you can do. So everything that exists in the traditional finance sense is kind of being decentralized and amplified in the DeFi world. And it's just a matter of time. So encourage people, once they fall down the rabbit hole of, earning their yield and some of this personal finance stuff, to continue going, because it's really, really true innovation happening.
Welcome to the Fund Your Retirement podcast. I'm Lee Cleesby, the co-founder of Fund Your Retirement. Welcome you back to your weekly insights from our expert guests in finance, business, and wealth building strategies, helping you fund your retirement. Today, I'm joined by not one guest, but two guests who are here to discuss what is DeFi, a deep dive into Bitcoin, the tokenization of crypto projects, and what is yield farming. Hello, Ben. Hello, Ted. Thank you for joining us today. Really appreciate you coming on the show. It's fantastic to have you both here. Really been looking forward to this conversation, talking about cryptocurrencies, DeFi, Dapps, unpacking all this strange new technology to a lot of people, but for you two, you're experts in this field, so it'd be fantastic to get your insights and share your knowledge and information with people who are probably looking at this and thinking, what the hell is this new world? What's this new frontier? So yeah, it's great to have you on. Welcome to the show, guys.
Thanks for having us. It's awesome to be on.
Yeah, brilliant. Usually what we do start off with is like the guests to give a little bit of an intro and share their background and experience. So as I've got two guests on today, Ben, Ted, who wants to go first? Just a little bit of a short insight, a little bit of a journey background. And
Ted, I'll let you take it away. He's,
all right.
He's more eloquent than I am.
Yeah,
so.
Perfect. Thanks, guys.
I'll keep it brief, but so my background is actually in industrial engineering, is where I started out. And so got my degree at North Dakota State University in Fargo, North Dakota, have a fellowship through Stanford University, and worked for roughly 5 years at a large medical device company running our internal accelerator and incubator. So taking ideas that needed resourcing, funding, capital, etc., bringing them through that startup journey, eventually being spun out into their own company or brought in as internal products. Made the jump into the Web 3.0 space, last year. It's been a fantastic time. Been around the space for a very long time, though, and I think that's kind of a fun story to share. Yeah. I remember my earliest introduction to, we'll say, Bitcoin was in around 8th grade. So that would be 2012, 2013 for me, gambling it and doing some activity on, what used to be the dark web at the time. And so been in the space for a very long time. Unfortunately, did not hold on to my bags, when the whole kind of Silk Road went up, but, got back in 2016, 2017, and now on the developer side, it's been really exciting. So live in the space of innovation, entrepreneurship, and have a weird kind of fun story on the Web 3.0 space, but we're in it for real now, and it's been very exciting.
Brilliant. Absolutely excellent. So you were in really early then, right at the beginning. So that's, really good. Ben, please.
No, it's his story. It's amazing to think about if you would have held on to some of that, but it's a better story.
He probably won't be on this podcast right now, would he?
Exactly.
He'd be on his boat somewhere, sipping champagne.
Ignoring our calls.
Yeah. His PA will be dealing with emails coming in. Exactly.
No, my background is actually in the M&A field. I was actually with a company in the UK, the EARS Fire Engineers, they're called now. It used to be the EA Group. But kind of was on the M&A arm for them in the acquisitions with Josh Wheel. And at the time, I was a very big protractor to digital assets. Regurgitated a lot of the rhetoric you hear in the media and the rhetoric that's starting to fade away, thankfully, through education. But, Bitcoin, it's backed by nothing. It's only used by criminals, started saying all of that to my friend. And he was after me to, keep doing due diligence on it, look into it. He wanted to put money into it. So I went down the rabbit hole, and the more immersed I got, the more it made sense to me, which I didn't like.
Right.
But thankfully, I've got the ability to pivot in my mind. So a few months later, I was, putting money in, and the scarcity aspect made sense to me. The only 21 million, and got even further immersed. Got involved with a few projects, writing for them, helping advise them. That was a few years later, and then Ted, I actually had coached him in baseball way back in the day. We're actually from the same town of about 700 people. Brilliant. In Minnesota. So when this project came along, he was the first person, probably the smartest person I reached out to on all of this. And that's how Scholar kind of, took off for both of us. And it's been amazing to bring real world use cases into the digital asset space. And I'll probably be very repetitive on that, but that's something I believe in very much, because it cuts out a lot of middlemen and just wasted funds. So and leaves money in the pockets of those who need it most. So that's a short intro on me and kind of my ethos.
No, fantastic. And we will get into Scholar, which I know is your project that you're both working on. And it sounds great, looks great, and I can't wait to share that with the audience. But before we get down into the nuts and bolts of the main sort of topics, I want to start from a 30,000 foot view. And if you could just share for the audience that's listening that don't quite understand, what is DeFi? What is decentralized finance? What does that mean for them who are listening to this and on the sidelines and scratching their heads? Because there's a lot of people still are, especially the older generation. So if you could take the lead on that, that'd be fantastic.
Yeah, so to me, decentralized finance, or DeFi, is kind of an umbrella or a blanket term that encompasses a lot of different things. The most important thing about decentralized finance, though, is that first piece, the decentralization, where it's not, a central bank and a government controlling the funding, the money. You'll see a lot less of the, what I'll say, institutional power that we have today in traditional finance, and it's more so peer-to-peer networks. Of course, that peer-to-peer, transactions, those marketplaces are facilitated by what we call Dapps, or programs. But all in all, it works down to I'm transacting with another peer instead of me transacting to an institution, which then runs it back to the person I'd eventually want to do that trade with. So it's that peer-to-peer network, and because of that, we call it decentralized. The other thing that means is that they're kind of more so autonomous and less so governed by these large kind of bureaucratic processes. So it's the truly peer-to-peer side of it that makes it more efficient and kind of a little bit less subject to the harsh regulatory pieces, or the more so the bureaucracy side of that.
If I could just add a very layman's to that, the part I love about DeFi is it gives the normal person the ability to kind of have some of those profits or dividends that the regular bank would be taking. And I never realized just what of a big chunk that they actually take. It's amazing. And the bank operates for its shareholders. So, and now you've got a protocol that operates in the, I guess, best interest of the users, and everyone is sharing in that profitability. And that's what I love about it. Ted's the expert in DeFi, though.
Yeah. So essentially, it's literally removing that middleman, and it's literally peer-to-peer. That's a simple man's explanation. It's peer-to-peer. There's no middleman, and it's completely trustless is the terminology, isn't it? So you mentioned there, Ted, Dapps. Would you mind expanding on what Dapps are then for the audience, please?
Yeah, so the best way to think about a DApp, or what's known as a decentralized application, is that you need something to facilitate these peer-to-peer transactions. I'm not going to send somebody an email and set up a way to send Bitcoin. It's much easier to find that in more of a marketplace to conduct some of that. So a DApp is essentially that. It's a protocol that facilitates these transactions in a simple way. It does take a small fee, but those fees are distributed back to kind of the community members, or the members of the protocol. So best way to think about that is the tool that facilitates some of them. And from a kind of a technology standpoint, is that they're run on a decentralized network. They're run on a blockchain style network instead of a single computer or node or kind of institution. So they don't have, again, the trustless term you had mentioned is very important, because they don't rely on a single authority to operate.
So where can we access a Dapp now, say, for example?
Yeah, that's a great question. So Ethereum is a protocol and a blockchain that has Dapps built on top of it. That's kind of like that back end. And I guess for people that are looking for something kind of familiar to it, it'd be like, AWS is the backbone for a ton of different operations. And so that's where you'd have kind of that core technology. Dapps are built on top of that. And how would you access them? I would say that landscape has dramatically changed in the past, probably 2 years. It used to be very involved, very burdensome from a technology standpoint, but to access a Dapp now, it's as simple as downloading MetaMask, which is a very simple wallet from your Google App Store. You can download stuff from the Apple App Store that is kind of connected, or a Dapp. And that's kind of your easiest entry. Now you can get way down into the rabbit hole and get back to the truly kind of decentralized and the really kind of robust feel, but access has become much, much simpler. Simple as looking up things like, what are called DEXs, or kind of crypto trading, right onto your phone. And that would be considered a Dapp because it does interact with the blockchain.
Yeah. So these Dapps are almost the same as like we download an app on our phone as we do every day sort of thing. Download an app from the App Store, download a Dapp for the crypto world. Similar sort of thing.
Very similar. And I think, there's kind of a mixed spot where another key feature of a Dapp is that decentralization. So some of the ones that you might get on your traditional app store, call it Voyage or Coinbase, are a little bit more centralized, but that's probably the closest, step into this world. There's a lot of more great examples of, truly decentralized Dapps, and we can kind of get into that as far as what ones exist today in different areas. But I think, someone who's just getting started, those are great stepping stones. And once you fall down the rabbit hole, there's even more decentralization. Decentralization, I wish it was a binary, is it decentralized or not, but it tends to be a little bit more gray. It's more of a scale. How decentralized is a project is a question that we ask quite a bit, and it's hard to measure, but you kind of do your best.
Yeah, well, I guess it becomes a moral question, doesn't it, as well? Because not everyone is at the point where they can appreciate the power of decentralization, because it gives the individual ultimate responsibility, doesn't it? Which is good in a way, but then there's people that also need protecting as well, isn't there, from bad actors? So I guess it's getting that balance right, isn't it?
Yeah, and it all comes down to doing your due diligence and doing your own research, and only taking those bets you feel comfortable on, or getting your feet wet with money that you can afford to play around with and learn from.
Yeah, I mean, would you also say that the adoption of this new crypto world, Bitcoin as an example, it seems to be like a bottom-up scenario, doesn't it? It seems to be coming from more the individuals as opposed to the institutions, should we say the less developed countries like El Salvador, Tonga. Go on, Ben, sorry.
It's amazing to see that happen, because, traditional industry, and it's kind of in the US anyways, it's front run by venture capitalists and high net worth individuals. And a lot of that is predicated on our law of accredited investors. And that's one of the things that the digital asset space opens up for the normal person. They've got the ability to access these projects from the very bottom, square one, and grow it up. And as you touched on, for the developing world, I hear it all the time in the States, who needs Bitcoin? And while I'm not the biggest proponent of Bitcoin being a monetary means, it is for a lot of these emerging countries. You're looking at Western Union, MoneyGram, taking 40% of these remittances getting sent to El Salvador, getting sent to Tonga. And Tonga, half their GDP is a run on remittances. So you do the math and you think how much Tonga could increase their GDP if they don't have these middlemen taking these exorbitant fees. So with Bitcoin, it's portable for a lot of these countries. And I happen to believe there's a lot better digital assets to send for remittances. But for someone sending money back to, say, Mexico, they can send it under a minute. The fees will be less than 1%, even with using a Coinbase.
Right.
And it's there automatically. Another problem a lot of these underbanked countries have is, to receive MoneyGram or Western Union, a lot of these people in villages are traveling 2-3 hours to get there. It's a nightmare. So I love that it's putting the money back into the people's pockets who need it most. And it also lets them access financial instruments. So you look at 31% of the world right now is actually unbanked. And then there's another 15% that's very underbanked. And then you run into the issue of national fiat currencies having all sorts of issues, deflationary issues, or inflationary issues, I should say. So now they can access stable coins, hold part of their savings in US dollars, and on these apps, they can actually access interest, yield accounts, even if it's 5 or 6%. Most of these people don't have bank accounts. So it's an amazing fact that now they can access financial instruments and all of this just through a smartphone.
I want to get into yield accounts shortly, if that's okay. But you mentioned something there that also intrigues me. Do you guys believe that Bitcoin, because Bitcoin is the biggest, it's the most well-known, do you believe that it's a store of wealth or a monetary system, or is it both?
Yeah, I can go first. I think we'll probably have differing opinions. So I do believe it's a store of wealth. And I believe it's going to continue to be a store of wealth, mainly because of the changing of the guard per se. 25% of millennial millionaires right now have over 30% of their net worth in digital assets.
Wow, that's a number.
Then you look at, it's crazy. And you look at CNBC did a study, and 92% of millennials preferred Bitcoin as a store of wealth over gold. So I think you're going to see that shift in the narrative, and that actual baby boomer transformation of wealth is coming. So a lot of that money, I see it flowing into digital assets. So for me, it's a store of value, mainly predicated on scarcity and just a changing of the guard and changing of a mindset. There's a lot of people that believe in the monetary system, like Bitcoin will be the only means of transaction in the future. But for me, if that does happen, I think we've had a very large doomsday scenario.
We don't want that.
No, and I think there's lots of building. Bitcoin traditionally is very tribal. They don't like these other crypto projects. So there's starting to be some building on top of Bitcoin, to access the Lightning Network. And so I think Bitcoin can coexist with the US dollar. I think there's going to be a stable coin on Bitcoin within the next year or two. And I think the rails of Bitcoin could help enhance some monetary policy in certain countries, but I don't personally see that taking over. And if it does, I think some bad things have happened, and we're probably not worried about where the price of Bitcoin is. It's, worried about getting food with Bitcoin. So,
okay, let's hope.
Sorry for the long-winded answer.
No, it's perfect. Yeah, Ted, what's your thoughts on that then?
It's a really great question, and I would share some of the same sentiments but I'm going to lean towards and say that in theory, when Bitcoin was, the original white paper, it's set out to be currency. It's known as a currency, and it's kind of theory. Now, we all know theory and application look very different. And so as of now, I think, a hallmark of currency is stability. And clearly we don't have that level of stability yet in Bitcoin, in a digital asset, that it can be kind of viewed that way. For that reason, I think that, yes, it's a store of wealth now. Will it ever become a currency? I think it'd have to see a lot more price stability. It's really interesting though, just because I think that there's some misunderstandings around kind of the purpose of it, and that Bitcoin is, in me, yes, it's a better form of money. So while it's a form of holding wealth, at its core, you need to understand what is money. And I think that Bitcoin is just a better way of doing that. It's peer-to-peer. It's not coming out of one centralized kind of point of control. It's deflationary. So there's all these different hallmarks that make it just a better form of currency. It just has not reached that level of maturity yet.
So it's a few interesting things you said there. Misconceptions. There is a lot of misconceptions around Bitcoin, isn't there? For example, the electricity usage, and whether it's good for the planet, especially as we move into this new green era. So before I get on to where do you think price of Bitcoin will be, which I'm sure everyone wants to know, and that's the question that everyone's waiting for, what's the misconceptions around Bitcoin, such as the electricity usage, and China recently banned mining in the country, think examples like that. What's your thoughts on the misconceptions and how to address those?
Yeah, so and just to touch on China really quick, I think they're a big driver in pushing out a lot of the Bitcoin miners, and other digital asset projects actually got pushed out of China as well. So they have the digital yuan, which they've been rolling out for a couple of years. They want a cashless society, which is very indicative of a totalitarian government that wants to track everything you do. So I think that's their big driver there. They don't want anything to compete with that, and they want the digital yuan to be used for everything.
Right. Yeah.
To touch on the mining, so I think it's also a matter of perspective. If you don't believe in Bitcoin and you think it's just magic internet money that criminals are using, you probably don't think to spend 1 cent on it, deserves any of that output into the grid. So I think a lot of the, the misnomers are around what Bitcoin is, and thankfully we're still early. So I think if you look at in North America anyway, 67% of Bitcoin mining actually leverages renewable energy right now. So that's double what any other industry is. So it gets a bad rap for sure. And then you've got the ESG compliance coming in America. So a lot of these administrators of funds, like with the O'Leary Fund, they're actually signing off on some of these ESG compliance issues. So that's kind of a green light to, we are moving more renewable. But at the end of the day, I don't think there's some major protractors, and they're going to be mad if it's 98% renewable. So, and on the other, kind of the misconceptions, one of my favorites back in the day was Bitcoin's only used by criminals. Right.
That's a common one you do here, don't you, still?
Exactly. So, and you look back towards the Silk Road days, and that's kind of where a lot of that started. And, the CIA came out with a very interesting study, and they did like a 6.5-year study on Bitcoin and what percentage was used in illicit finance. And it's under 1%, which shocked me. And that was part of my original due diligence. So you look at the traditional banking system, and it's almost 3%. That shuts that narrative down right away. And that amazed me. And the beauty of Bitcoin is there's also this misnomer that it's, completely anonymous. Well, it is, but in all of the first world countries, you KYC into an on-ramp, which is like an exchange where you can on and offboard fiat, and Bitcoin can be tracked anywhere. And that's, you just heard about the Bitfinex hackers who in 2016 hacked $71 million worth of Bitcoin. Yeah. They've tried to launder that through any means necessary, and it turned into like $3.6 billion. Well, the feds have tracked this nonstop, wallet to wallet, and they've cut it in hundreds of millions of pieces, tried to put it through these mixers that exist, and they still got caught. So I think that's the of Bitcoin, is it is transparent, it is traceable, and you're not going to see, illicit uses on Bitcoin for much longer. In the countries that you're seeing it in are some of the emerging markets where the financial incentive is there. And I don't know, there might be people getting paid off, or just the infrastructure isn't there to go after them, but it's coming. India's recently put in some really good practices to catch a lot of these malware hackers that you hear about. But so I think the criminal aspect has kind of been shut down on Bitcoin. And then from the other perspectives, Ted, you have any false narratives that?
Yeah, I've got a few. So, the first one I think you brought up was the energy consumption. And I'll just add a quick note, not to exhaust it. I think that argument is pretty myopic. If you think about traditional finance and traditional money, it's something like it's 13 middlemen before my transaction goes through when I use a credit card before it actually gets settled. And so if you look at the power consumption of all these different companies, the human resources allocated to it, I think that argument starts to kind of fall apart the closer you look at it. From the criminality standpoint, echo everything Bennett said. We're kind of seeing that go away. Yes, it was kind of its original use case. I was there doing some of that, nothing that, was too bad, but, we've matured so much. And I think that's, number today is that I think that Bitcoin alone settles something like $10 billion worth of transactions a day. Yeah. And so it's here, it's not like it's this kind of super early thing right now, at least in that sense. It's matured quite a bit. Other things that I hear all the time is that the government's going to kill Bitcoin. It's only exists until they put their foot down. And that's the beauty of decentralization. I think that's why we hear so much about it. The geopoliticalization of Bitcoin has been really, really interesting to watch. Because it's a huge threat to them. It's a huge threat to the Fed because they don't control the money supply anymore. And that's obviously very concerning as a nation. So I think they need to be more strategic and forward looking and saying, how do we, treat this as something that benefits all of society and not just the Fed controlling things like that. It's really interesting though, because if you do your due diligence, like when you look at a crypto, you'd look at a few things, what's the supply, how many nodes does it have, how decentralized in it. And if you were to apply that same kind of analysis to like the US dollar, you realize 40% of it's been minted in the last year. There's a single node that controls all of that, and it's unlimited supply. So if I looked at that and was doing my due diligence, that's a token I would never buy. And so it's kind of interesting as we kind of think about that government side of things. It's really, I encourage people to kind of, apply the same due diligence you would do to any other asset and say, how good is this? And then go ahead. Sorry.
No, please carry on. Please. Sorry. I didn't want to interrupt. Sorry, please carry on.
No, you're good. And, kind of the last one I'll say that is, there's the corporate currencies or kind of the CBDCs, the central bank digital currencies are going to kill crypto. And the last thing I'll share is that, Ben had shared a little bit about what China's doing with that. And they're marketed sometimes the CBDCs as this is all the good of crypto with the trust of your government behind it. And then they're honestly the scariest thing happening in crypto to me today as a CBDC, because it takes away the decentralization, but they keep all the glamour and the attractiveness of this is a digital currency. So it's the last thing I'll say, and is around volatility. And people say, oh, well, compared to gold, it's extremely volatile. But if you look at the history of gold, and I think it was the 70s or 80s, that was extremely volatile as well. And so I'll say Bitcoin is not an infant, but it's on its way to maturity and it's starting to stabilize out. So I think as that goes away, some of those kind of concerns around volatility start to fall away too.
Well, you mentioned two really quite important things that I wanted to unpack. You mentioned nodes and tokens. You mentioned that the US dollar has one node, and you mentioned when you analyzing a project, how many nodes does it have? So can you explain to the audience what you mean by nodes and why is that important? Why is nodes, as you said, one for the US dollar, multiple nodes in a project is important to know? So yeah, why are nodes important? What's the meaning of nodes?
So the best way to think about a node is kind of validating. So in blockchain, it's essentially what we call the common ledger, where we can see the activity back to, kind of the origin of the blockchain, and we can see whether or not what I'm saying is real. Is this transaction real? Did both parties kind of consent to it, and does it confirm with the rest of the block? So that way you can't force fake transactions, and that way crypto can't be sent to wallets that don't deserve it. So it's kind of that security check. All of that, when you hear about Bitcoin mining are essentially these nodes that say, yes, this transaction is valid. It matches our record on the blockchain, therefore kind of conduct it. So the incentive for as a miner is you get rewarded for doing that. Okay. And so we think about nodes, it's essentially nodes/validators to make sure that the activity on the blockchain is legitimate, that it matches kind of the common ledger, and that the entire network has a level of consensus is kind of the most important piece there. So in the US dollar, that's obviously the Fed. They control the supply, they control the circulating supply, all these different things. But it's way more decentralized in majority of different cryptocurrencies. And so that validation is done. And then most oftentimes you'll either have a set kind of circulating supply or kind of a set supply like 21 million Bitcoin, or sometimes they are controlled supply, but it takes more than one person to make that decision. So it take a consensus of all the people validating. If we want to increase the supply, we all have to vote to do so. If we want to decrease, we all have to vote to do so. So it's way more democratic from a consensus point.
Cool. So tokens as well. I'm going to quote Ben here with an article that he wrote on Hackernoon, if that's okay. So to quote Ben, digital asset projects will continually eat away at legacy middlemen businesses, and they will replace them with protocols that will do the work 99% cheaper. I think people are starting to slowly realize there's much more going on in this space than people trying to make money. Tokenization will dramatically eat into traditional equities, close quotes. What do you mean by that, Ben? What does that mean? How will they eat away at traditional assets?
Yeah, so I think it goes back to, some of what I touched on before. Just there's a lot of room in these businesses and traditional companies to take out a lot of these middlemen fees that exist. So even like supply chain management, you look at projects like VeChain or like Unibright. All Coca-Cola right now, if you drink Coke, is tracked on blockchain, and most people don't realize that. And the consumer at the very end doesn't need to know it either. And I think that's an important thing to remember, that pretty soon we're going to be consumers of blockchain technology and we don't even realize it. But real world assets, you can actually prescribe metadata to them, put them on the blockchain. How it works in supply chain management, there's a QR code attached to everything, and every time that gets scanned in, that actually is recorded on chain. So you can find inefficiencies in the supply chain. Is production here lagging? Why is this happening? It's a really efficient way to find those inefficiencies. And then you look at like real estate. There's a lot going on right now of tokenization of real estate. You look at real world assets and real estate, it's a top 3 asset bucket. Right. And with that happening, it's exciting to think about, recording even your title on blockchain and not having to go down to the records and get it signed off, and it takes weeks. Like, this could be real time, instant, and verifiable on the blockchain, which I love. And I think you just look at all of these, even the tech industry, there's so much room to tokenize things and have them in a trustless sense versus a centralized sense. And that's happening. You look at, I'm sure you're familiar with like Kevin O'Leary from Shark Tank, the US's version of Dragon's Den, like you guys have. And he was a major protractor to the space up until about a year and a half ago. And he's all flipped,
hasn't he?
Absolutely. And what's clicked for him, he likens these protocols like early software companies. So you're owning a part of that protocol, but it's community driven. And if the users in that network are getting more value out of the network than they're putting in, they're going to stay. There's actually a sense of community and ownership within that protocol. Even though it's not shares, it can be in tokens, and there's a belief in the project. So I think that pushes it forward. And real world assets, there's a new project that's taking on like paymaster services. So contracts that they want to settle in real time. Most paymaster services, can take 7 to 10 business days to close. Well, with digital assets, you're open 24/7. So I think they just onboarded like 560,000 in their first week of business. A lot of like steel contracts that want to close right away. So if you think about over a year's time, if you calculate that out, there's huge opportunity for the world that's open 24/7 like digital assets.
Yeah. But when one part of the world is sleeping, the other part is awake, isn't it? So there's always business going on. There's always opportunities. So sorry, please.
Oh, go ahead. No, go ahead.
If I could summarize then, so tokenization is a project where traditionally people would buy shares within a company where they would have their kind of project, their mission, what they were selling or offering as a service. Tokenization is the same thing, but instead of buying shares, you're buying tokens within that project, whatever that service is offering. Is that right?
Yeah.
Have I summarized that right?
That's the way I look at it. I know the SEC does not like to think about that because technically that falls under securities laws. But there's some platforms too where you're rewarded for participation and governance. So there's some of these protocols where they put like improvement proposals or voting proposals out. And if the community members want to take that project or have vision to go a different way, they can actually turn down a lot of these decisions. So that's the, kind of the stickiness and the glue to these projects to keep community members feel incentivized to stay with it. But what you said is completely right.
So is the community members then like an AGM then? Like a stock listed company would have an AGM. The community members are constantly having the ability to vote on the direction of this project, whatever it may well be. Is that a fair comment?
Yeah, I'll let Ted touch on governance there because it works a little different with a lot of projects. He's an expert in it.
Yeah, so what you're kind of touching on, what we call in the space are DAOs or DAOs, decentralized autonomous organizations. And so instead of having a C-suite level kind of group of leadership making the decisions and cascading them down, it's all done in way more of a democratic process. And so we each get voting rights based. Sometimes it's just for being part of it. Sometimes it's proportional to how many tokens you hold. But essentially, yeah, it's, different things are put up for vote. That scope is determined by the owner of the protocol. So we're not voting on everything. Maybe it's just our roadmap proposals. What are we building next? Or maybe it's rates and, some of the, how our protocol operates. So it's called the DAO, and some of the scope of it can be limited based on the project, but it's essentially that. It's a consensus mechanism. A quick note I want to make is that you've heard Ben and I use the term digital asset. And we're way more biased towards that because we feel like the term cryptocurrency kind of paints yourself into a box. Web 3.0 was much more than just kind of a financial revolution in a lot of ways. Ben talked about the, supply chain. There's, we're working in charitable giving, other things like that, but it means a few things. So when we say digital assets, that's things, not just currencies like we would think of, Bitcoin and others, but it makes sense even from a regulatory standpoint. Digital assets can be properties. They can be securities, like Ben had mentioned, where you're expecting some sort of return, or they can be a currency. And so underneath those are so many different projects, so many different applications and use cases. And so that's why we use that term. It's a little bit more inclusive. And so we think about tokenization, it means different things depending on, is it a currency, security, or property?
Understood. Yeah. So just to delve a little bit deeper into this area, if that's okay, you mentioned real estate in Ben, and also, so how will these, and we've talked about projects, we've talked about tokenization, how most people can understand the idea of real estate. How is tokenization and these projects going to affect the real estate market? How would they be able to benefit from, the high-end real estate, say, for example, and well, pretty much in the Western world, house prices are exponentially rising. How can people who are not able to access it, how can they access it through this tokenization?
Yeah, no, it's a great question. I think tokenization just equals inclusiveness, right? You don't need to be a high net worth individual or an accredited investor that traditionally these properties, say a 200 million pound flat in central London. Now someone with $200 in Birmingham, Alabama, or in India, anywhere in the world can come and have access to one of the greatest pieces of wealth generation in the world, which is real estate. Yeah. So from an investor standpoint, it's just access to great properties. And also if you're a developer, now you've got a whole new means to funding, whether it's bringing in investors to actual tokenize a project, and then cutting out the red tape, I think is another huge piece of it. There's large pushes in certain counties in the US already to record things on blockchain. And it's very early days, but I think in 10 years from now, it's drastically going to change the way a lot of this red tape, whether it's recording of deeds, closing, escrow, all of that happens in real estate. So it's an exciting world. And just from an access point of view, I love that it gives these developing nations access to things in the Western world, because traditionally, if you're in Venezuela, you've got access to your fiat currency, which is worth almost zero. So it democratizes access, and I love that.
Yeah. So to kind of paraphrase there, summarize, basically, if a developer there has got multi-million-pound project, usually they would go to high net worth individuals, high investors, professional investors to get the capital to execute on the major multi-million-pound project. But with tokenization, what you're saying is they can put it out to the open market, and an individual from India can put in their £200 and can benefit from that multi-million-pound real estate investment. Is that what you're saying?
Absolutely.
That's really good. The on and off ramps are so simple too. So since it's been tokenized, there's so many different exchanges to, the actually getting that asset is very simple. And especially, when it comes time to sell, also very simple as well. So it's it just makes that on and off ramp super simple and democratizes it for everyone. So super high value.
And I'm presuming for the individual, there would be the ease at selling their ownership through the blockchain would be peer-to-peer as well. So let's say their $200 has gone to $2,000, $200,000 in this project, this real estate project, they could just literally sell that peer-to-peer to another investor on the network. And I'm going to guess that they would access this network through Dapps.
Exactly.
Yeah, absolutely. And that's the beauty of it. You've got instant liquidity there. You look at some of these, obviously there's real world fractionalized ownership real estate companies out there. Fundrise is a big one in the US, but you get all sorts of penalties if you want to withdraw. And usually, your time horizon needs to be about 5 years not to incur any penalties. So, this grants access and liquidity, which I love.
Yeah, no, it's fantastic. It sounds really cool. So how far are we away from that being, quite mainstream, or are we already there? Is there companies that are already acting in this sort of way?
So outside of the US, there's companies that are already doing this. There's a few hotel projects, one in central London right now that's getting funded through the blockchain. I can shoot you some links on it, but Eastern Europe actually has a lot of development in this. The US, there's regulatory uncertainty around it because there's the expectation of profit. So while that's the case, there are some, I don't know if we call them cowboys or what, but they're proceeding with it and starting to go this route. And they're comfortable that the decentralized aspect meets more of a commodity requirement than a security. But to answer your question, it's very early days, but the blockchain space moves so fast, as Ted and I have found out from a developer standpoint, that it could be 2 weeks from now and there'll be a lot of houses on the platform. So there was a house in Florida that actually just got crowdfunded through it as well. So it's early days, but it is happening in the US.
Yeah, and like what you said, it's moving so fast. Before we know it, it'll become, part of probably common everyday sort of work. Most people will be aware of it. So yeah, fantastic. So move the conversation along. Yield farming. We're hearing a lot about yield farming, and Ted, I know this is your area of expertise. Would you like to explain what yield farming is?
Yeah, so yield farming, the best way to think about it, I think the closest real world parallel we have would be the interest that your bank provides you on something like a savings account. And
which
so what
is
you're
zero
doing
at the moment.
Zero or very low. I know,
very low at the moment.
You're supposed to say thank you for a high yield savings account, at least here in the US, I think is 1%. And I'm supposed to be grateful for that.
Yeah,
and as we get into the conversation, we'll learn that that's pretty bad. I mean, inherently, it's bad, but there's way better options. But what you're getting is essentially rewarded providing liquidity to basically to make swaps to the yield farming. So it's essentially what you're doing is when I go to like a what's called the decentralized exchange, and the best way, we have to establish what that is. So think of all the different cryptocurrencies that exist today: Ethereum, Bitcoin, there's thousands. So where do you go if I wanted to swap Ethereum for Polygon? Where can I do something like that? That's called a decentralized exchange. And so instead of the best way to think about this is if I were to go exchange a US dollar for a euro, I could go to a bank that would have both of them on hand. They have that liquidity and can provide that, and they take a small fee. That's essentially what we're doing in a decentralized exchange, but instead of one bank having all of it, a bunch of people come and put all of their different cryptocurrencies into it. And so these decentralized exchanges may have thousands of tokens, and what they do is essentially provide a fee. So if I wanted to swap Ethereum for Polygon, I get a small fee. The exchange charges a small fee to me, the swap person doing that. Yeah. But then what they do with that fee is really unique, is that they give it back out to all of the liquidity providers. And so this is where that yield comes from. So when I provide liquidity to an exchange, in return, the fees that they generate for people doing swapping tokens is given back to those kind of liquidity providers. It takes shape in a few different ways, but that's a very basic thing to think about. It's fueled by something called automated money makers. And so sometimes it's counterintuitive, but say I wanted to go from US dollar to euro, sometimes it makes sense to swap to a different currency in between so I can get a better rate. So there's a little bit of arbitrage that happens. Yeah. And so that's just, 2 or 3 currencies. Now expand that to, hundreds. Maybe there's an optimized route to get from Ethereum to a better, the crypto I'm seeking, but it takes 5 or 6 steps. And so along the way, I get lower fees as an end user, but it also provides liquidity to a lot of these different kind of areas. So the best way to think about it is when I put my tokens in, people are using that liquidity and I get rewarded a small part of that fee, proportional to the pool.
Right.
So that's kind of what yield farming is. And so takes shape, like I said, in different ways. There's staking, yield farming, and what we call liquidity mining. They all kind of happen in different ways and probably too in depth. But the incentive there is that there's not a central authority taking those fees. The job of the automated moneymaker is to give those fees back out to the users.
So you're essentially providing the liquidity to the network. Is that fair?
Yep, in the very simple terms, and just wanted to kind of point out the difference is that it's those fees are not centralized; they're given back out to those liquidity providers.
Yeah, so instead of say HSBC or Goldman Sachs getting the fees for providing liquidity, they're being given back to the individuals like yourself, as an example, Ted, for providing that. And I'm guessing the larger the amount of liquidity you provide, the higher the fees that you receive. Is that a fair comment?
Some pools are set up that way, but oftentimes it has a lot to do with the assets that you're providing. So, okay. Things like stable coins, which are pegged to a fiat currency. So most commonly the US dollar, things like USDC, USDT. Usually the yield is a little bit lower on those just because there's not that underlying risk. That continues to scale up. So if you're looking at kind of we'll call blue chip, crypto, Ethereum, Bitcoin, etc., you'll see higher rates on there. And then the very small cap coins, the returns are very high. So it has a little bit to, what's your skin in the game and what's your risk for providing liquidity. And some of them do incentivize. The other piece, instead of the more you provide, it's actually how long you lock it up. Yeah. And so when I say I'm going to provide this liquidity for 6 months versus 2 years, the 2 years are traditionally going to have much better rates. And it's also really nice because it kind of puts some deflationary pressures into the ecosystem, and which is really kind of cool to see as well. Yeah.
So, okay, that's starting to make sense. So what type of returns can we expect from these type of yields then, the yield farm?
Yeah, it's a great question. And so I kind of mentioned 3 categories there. The first being stable coins. So right now on apps that are super simple to use, at least here in the US, things like crypto.com, Voyager, etc., you can earn anywhere from 9 to 11% just for basically holding stable coins on their platforms. And a reminder of how simple that is, like if you can use an app like Robinhood and connect your bank account, you can do this. And right. So what we've seen a ton is that people will actually treat them basically as a high yield savings account that's 10 to 11 times better than what any sort of large bank is providing you.
Yeah.
If you're willing to kind of take another step and truly get into the world of DeFi and manage your wallets and things like that, you can see anywhere 20 to 50%. And that's unleveraged. Leveraged stable coins anywhere from 60 to 80%, which is crazy because that underlying asset is very, very low risk. And that's actually kind of a core backbone of our business model too. As you move into kind of the blue chips or kind of, the big ones, Ethereum, Polygon, the big names, depending on the pools, you could look at anywhere from 60 to 80% for providing liquidity. Sometimes that can be higher. There's really unique and honestly a ton of innovation happening in this space as far as how rewards are given out. And then what I'll call the moonshots are kind of the very small cap. You're looking anywhere from 500% to some of them are like 30,000% auto compounding. And
wow,
you can see like that sounds super attractive, but that underlying asset at zero compounding 30,000 times is still zero. But a little insight, people might ask, why are they so high? Being that we're just starting our journey, when you first want to get your token out into the ecosystem, you can provide really high APYs because then people flock to it. They'll take that risk. And so you try to get your token into as many wallets as you can, get as much of it circulating as you can. And so oftentimes you'll see those APYs start super high, but taper off as that token kind of gets disseminated. So you can use liquidity to kind of drive demand for your token and get it out into the ecosystem, which is really cool.
It's amazing listening to you because it's like I'm sure for equaling myself on this journey, it's opening up a whole new world, and I'm sure for the audience it is as well. So where do you see this DeFi space, this yield space going? Do you think it could replace the interest, the savings accounts that we used to once get 4, 5, 6, 7%, where the bank would say, "Hey, thanks, we'll hold your money. Here's 6% per annum." Do you think this could replace that? Because as we all know, savings accounts are yielding almost zero. It's pointless having money in accounts really with inflation running at 6, 7% anyway.
Yeah, it's hard to know, kind of to speculate on what I'll say. Is it going to overtake the kind of traditional banking? I think that they'll start to adopt a lot of that mentality, and as that happens. But in my opinion, it'll be more so on the consumer side. Like, I personally hold less than $1,000 in USD in an actual bank account. It's all mostly held in stables, because why would I not? I'm missing out on 12% on our currency is inflating at 7% a year. So I think that it'll drive that, and the banks will have to compete to keep up, honestly. So I think it'll replace it from an option standpoint, not like a bank coming out saying we'll do it better. Within that, of course, you got to be wary of risk. Some stable coins pools are better than others. There are collateralized options, like Circle is a big one that yields are 6 to 12% depending on what you choose. So traditionally much safer, but obviously your yields go down. But still, comparatively, that's 5 percentage points higher than what our highest offering is here in the US. So
sorry, Ben, please go on.
Yeah, I'm just going to hop in there really quick, just from my perspective. What I love about it, and talking about using it as a savings account, Voyager, who I think are coming to the UK, they actually have a debit card now.
Right.
So now they've got ACH compatibility as well. So you could literally put your savings in there and swipe your debit card, and you're still earning, 9 to 11% interest. So
wow,
it's amazing to me that's out there.
That's incredible, isn't it? To think that there is options to earn 9%, 11% on your money just sat in a savings account. Can we call it a savings account? It's probably got a new name, I'm sure.
Yeah, you probably need to call it something else.
We need to call it something else.
A lot of people, when I tell them about this, they just assume that, there's just a few people doing it. But if you look at, again, not to keep going to Kevin O'Leary, but I just love his story from Protractor, to he's fully immersed now. But I think they've got a 6% weighting in Circle and USDC that's earning this, and that's a Wall Street compliant, ESG compliant fund that's leveraging the power of DeFi and yield. So it's definitely coming mainstream, and now's the time to probably front run it before all these institutions get involved, and eventually, in my point of view, the yields will come down just with more participation.
Yeah. So it's moving fast. So you mentioned a few things there around about risk and things like that. So, where there's opportunity, there is always risk. And, I'm sure people listening to this are probably, need to understand the risks involved. How do you go about your due diligence? How do you gauge these projects that you're going to yield farm in?
Yeah, so the first thing I do is look at the underlying assets that I actually be putting in. Is it pairing, what I'll call blue chip assets? There's things like Ethereum, Bitcoin, ones that have been around a long time, have a ton of volume going through, things that we trust more than others. And if that's paired with something like a stable coin, that makes a ton of sense. So like the underlying assets are super important. If it's pairing something you love with some crazy volatile token, probably don't go into that one if you're just getting started. So it's choosing those underlying assets is probably the first and foremost, the most important. The second thing is to look at who's actually facilitating that liquidity pool. Is it a big exchange that does tons of volume? Things like Curve, things like Sushi Swap, all these bigger platforms that have what we call TVL, or total value locked. The higher that number is, the more confident I am that they've had success, they have a proven track record. So your due diligence comes down to what tokens are you putting in, what return are they promising to you, and how is it given back to you? And then the last piece is, what's the track record of who's offering this? Yeah. A quick note on how it's given back to you. So there's a ton of innovation happening in the space as far as when I provide things like, usually you do it in pairs. So I'd put Ethereum and USDC. I would expect to earn interest back in those two tokens. Sometimes what liquidity providers will do is called liquidity mining, and actually provide you a third token back on top of that. So it's kind of an incentive to go back in. So it's a speculative value of this third token. But if you want to minimize your risk, make sure that you're being paid back in the assets you put in. If I provide USDC, I don't want to get some magic internet thing at the end. I won't diss MIM too much. It is an actual real stable coin, but it's funny to talk about.
Yeah. So a traditional bank, fractional reserve banking, they take your money in, hold it as savings, and they'll loan that out without you kind of knowing, although they are. We don't see our savings account reduce, but they're loaning that out to other users of the network in a traditional banking sense. And for the interest that they earn for loaning that money out goes into the traditional bank and they earn that interest. In this scenario, what you're describing, you, the individual, the owner of the tokens, owner of the cryptocurrency, you are getting that interest.
Exactly.
If I just summarize that correctly?
Yep.
Perfect.
And the simple thing again is just what are you putting in and what are you getting out, making sure that those make sense. And that's about it. And the track record of, in this instance, what we call the exchange, or, you know, the other instance in traditional finance, the bank. You know, it's not a brand new bank, and it's got some, you want to make sure it has legs.
So it's literally giving control back to the individual.
Exactly.
Wow.
Yeah. And one thing to touch on, you mentioned fractional reserve lending, which, you know, I wish more people were educated on. In the US, actually, after the Black Thursday crash, they eliminated a lot of the fractional reserve rates that banks need to adhere to.
Right.
And it previously they would call the Fed Monday morning and tell them, you know, what their float amount was that they need access to leverage that 100x. So
yeah,
you look at all these DeFi components, they're already in the banking system. We just don't know about them, and we can't access, you know, the upside on them. But puts the power back into people's hands, and I love everything about that. And Ted's an expert on it, and he's educated me. You know, I'm more immersed in it now than I ever thought I would be. But
hey, well, you've both educated me massively, and I hope you've educated the audience as well. So, you know, really appreciate you.
We've just kind of come across the top of what DeFi is. Decentralized finance, like we had talked about at the very beginning, is kind of a blanket term. So we've talked about what are stable coins. We've talked about decentralized exchanges, but there's even more happening in the space, like lending and borrowing protocols, what they call smart loans that auto repay themselves based upon the interest you're earning. There's insurance for all of it. There's margin, different things you can do. So everything that exists in the traditional finance sense is kind of being decentralized and amplified in the DeFi world. And it's just a matter of time. So encourage people, once they fall down the rabbit hole of, you know, earning their yield and some of this personal finance stuff, to continue going, because it's really, really true innovation happening.
Yeah, brilliant. So as we come to the end of the conversation and everything, so because I'm respectful of your time, the audience's time as well, you know, what projects are you guys working on that you are passionate about? Because you mentioned Scholar, which I know is quite an innovative solution for the debt problem in the US. So, you know, how are you leveraging cryptocurrency and the crypto blockchain to solve that problem?
Yeah, so thanks for the opportunity to kind of quickly talk about Scholar. So Scholar, what we're doing is saying we're not necessarily solving the student debt crisis that exists today. There's around $1.7 trillion. But we're saying, how do we stop students from incurring more debt as they move forward? And our best solution, kind of the opportunity we've identified, is charitable giving and academic endowments. And so just to kind of think about, you know, traditional finance and the inefficiencies that happen there, in 2020, the average return on academic endowments being responsible for providing funding to students and universities, was 1.8%. And that 5-year average is around 5.2%. So as we've talked about today, we know that there's much higher performing assets in the DeFi space. And on top of that, traditional endowments have around a 4.5% overhead. So you get a small return, big overhead fee. And we know that DeFi has very low operating fees and high returns. And we said this is a perfect opportunity for us to come in. And so what we have is a solution for donors that give to these academic institutions to, one, reclaim control of how they're doing it. Right now, it's kind of a black box. I donate $100,000 to an endowment. It's totally up to them on how they spend it, right, what students are receiving it. And so what we said, we can give more control back to donors. So the incentive for a donor is, one, obviously a tax break for making the donation. Two, you get to choose what students or causes you think should be receiving that money. And three, you know that it's being grown exponentially faster than that would happen in traditional finance. The other side of it is that we do have a student-facing platform that exists today. It's called scholarful.com. And what this does is makes your application process much simpler. So as a recent college graduate, I remember back to the times of spending 45 minutes to an hour applying to each scholarship. Well, with our platform, you fill out your profile once and it's a one-click apply. So I find a scholarship that fits my needs, who I think I can, you know, win this one button click. And then we provide essentially that short list of top candidates to our donors. So in a very short essence, it's high performing assets for academic endowments, returning that control back to our donors. And then that last piece is we do have a small fee schedule associated with it. And that's how we engage our kind of tokening community. Again, considering all the other elements of DeFi that we've talked about.
Yeah. So the tokenization is there embedded into Scholar as well. People can buy tokens and participate in the project.
Yep. And so we're really excited because we have a number of different opportunities to kind of give. So one, by being a token holder, it is a governance token. So you can influence on kind of how money is being directed, how our protocol is being run, and our roadmap. The other exciting part is that we have what we call community funds. So maybe you're not super passionate about giving back to your alma mater, but you want to focus in on a particular kind of subset of students. Maybe it's women in STEM, Black engineers, something like that. We can have curated what we call community funds for that. And so by holding the token, you get to engage in what causes we're funding, which ones we're highlighting, et cetera. So it's a really kind of community involvement that we're excited about. And the monetary incentive, the higher our TVL, the higher the value of the token through our fee schedule, et cetera.
Yeah, no, brilliant. So in regards to a student getting into like debt to go to college in the US, is this going to like sponsor students to go to university so they don't get into debt? Is that a fair comment? Or
so the theory is it's a couple of things. So one, democratizing access to scholarships. A lot of the scholarships that exist today,
it's going to promote. You're going to promote scholarships. Yeah, apologies.
Right, yeah. And so by taking those on early, taking a scholarship, your debt's obviously lower because that's money that's been granted to you. And so honestly, one of the feedback we get from donors is that they have limited access to students.
Yeah.
Students just don't apply. A lot of them go unfilled and they kind of feel unsatiated, or kind of the reason they gave oftentimes is actually not financial. It's not that tax break. They're looking to make an impact. And so that's where we give that control back. So we try to take on student debt by providing more money to more students is kind of the theory there. Roadmap items we've thought about, what can DeFi do for traditional loans, but that's way far off. We kind of have our use case now. We want to establish ourselves as kind of a reliable project and token, and then we'll start thinking about what can we do for a much, much bigger problem.
Brilliant. And there you are, applying pretty much everything we've kind of discussed in this episode to a real world problem, and that's the debt crisis. So no, call it a crisis. The students in the US, it is a crisis, isn't it? I mean, many may not realize that in the 90s, Bill Clinton, passed a law that the students couldn't write off the debt, didn't they? So no matter whether you go bankrupt for anything, you carry that student debt all through life, don't you? So
yeah, the only way out, I think, is death, and so no one wants that. But it's exciting, and we're excited to get the community of students and eventually donors together too, and make that more impactful. So it's we're excited about the not only crypto, like we've talked about, it's associated with the usually making money, or it used to be crime, etc. But we're bringing a real world use case, a positive ethos, solving a real world kind of charitable or kind of social problem with crypto, and we think that's going to do a lot for the image of the entire Web3 industry too.
Yeah, and we've talked about projects throughout this conversation, and this is a perfect example of a project that's been worked on to do good. It's people that are probably scattered around the country, perhaps maybe around the world, coming together, working on a project to benefit a positive cause, and there's the ability to be part of it and by buying tokens and then have your say in it. Is that a fair summary?
Absolutely.
Yeah.
And I think for me, the exciting part is just cutting out these, the overhead and the middlemen fees that are there, and the underperforming endowments that really, should be there to serve a lot of these students. But I guess at a high level, that money doesn't all go to students. So putting the money back, towards the intended recipients is a huge thing for me.
Yeah. The individual donating can say they have much more say over where it goes and how it's used.
Absolutely.
It comes back to that whole decentralization, doesn't it? The power back to the individual. So,
absolutely.
Oh, absolutely brilliant. Well, I mean, you've definitely expanded my mind, and I hope you've expanded the minds of many of the audience as well. So really appreciate your time. Where can the people, the audience, follow you? Where can they connect with you? Where can they find Scholar? And I'll make sure the links are in the show notes below as well.
Yeah, so to learn more about our project, it's Scholar, SCH0LAR.io. Big site updates coming soon, so check back regularly on that. If you want to connect with me personally, definitely LinkedIn, Twitter are the best places for that.
Yeah.
And I'm sure you'll provide those links. Otherwise, just pop my name in and you'll find a pretty unique.
I'll add all the links below. They'll all be there in the show notes. So that's brilliant. Yeah. And Ben, do you have any Twitter handles or anything like that?
Yeah, I'll shoot them to you and you can throw it in the description. But I think and then watch, Ted's gonna start writing for Hackernoon soon. So that's exciting. You can kind of see his knowledge come through all of that platform.
Brilliant. I'll add your profiles for Hackernoon in the show notes as well as the links to Scholar and your Twitter handles. So guys, thank you very much. Appreciate your time.
Awesome. Thank you.
Oh, thanks for having us. We'll do it again.
Yeah, definitely. I'd love to. Perfect.
Take care.
Cheers. Bye.
Thank you.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and our website fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.